Hello friends and neighbors. So let's finish up chapter 5 with this last clip here that will cover slides 22 through 32. Alright, so these are really definitional terms. The book has a little section on what they call off-balance sheet items in banking, and so these are interesting techniques that banks use to help companies with their financing. So let's take a look at a couple of them. All right, this item called unused commitments. All right, so a line of credit is a loan that a borrower draws on only when they need the money. Okay, so each of these lines of commitments or lines of credit has a limit as to how much, or a ceiling, a cap as to how much can be drawn. And the difference between what a borrower has already taken and what the limit is called an unused loan commitment. Okay? So when an analyst is trying to ascertain whether a bank has good liquidity, one thing they look at is what unused lines of credit are on their balance sheet, because if the unused lines are really significant and the borrowers decide to draw on them, they really could impact the bank's liquidity. Also, you look at the borrower to try to determine the borrower's liquidity. If they have unused lines of credit, then that is a source of liquidity for the borrower. That's a good thing. All right, and then here's this thing called a standby letter of credit agreement, which is very similar to a banker's acceptance. Okay? This is when a bank guarantees payment to a third party in the event the owner of the SLOC, standby letter of credit, defaults on a payment to the third party. So it's guarantee of a payment, and it is a type of insurance policy. Okay, so the way this is structured, the customer who wants the SLOC will approach a bank and will pay a fee somewhere between 1 and 10% of the total amount in the letter of credit, and they're used primarily to finance contracts, and often when there are international transactions involved. When companies, when there's a great distance between companies and the people don't know each other, it helps to get an insurance policy that really smooths the business transaction. It builds confidence between the two parties, knowing that a very large third party will make sure that the deal will get done. And they're often either done for quality or time purposes, okay? Which means that the third party, the bank that issues the standby letter of credit, will guarantee that company A delivers the type of product at the level of quality that they promised, or that they deliver the quantity of product within the time frame that they promise. Okay? Otherwise, the SLOC gets exercised and the bank has to step in and make the payment. Okay? All right, so that's a big item used in international business. All right, some other things that are really significant, and we'll get into more detail with derivatives in a later chapter, but derivative contracts. All right, so we have futures contracts, and this is an agreement to buy or sell assets like bonds, stocks, currencies, interest rates, and commodities, which include agricultural commodities, industrial materials, oil and gas, and precious metals. Lots of different types of commodities. Okay, so the amount and the pricing and the timing are all established in the contract. And these contracts are used to lock in terms, how much and when, and to manage risk. Okay, so that's a real legitimate use of these contracts, which is how they came into being to begin with. And I'm sure I know we've covered this. If you've taken investments, we've covered this, probably covered it in economics and accounting as well. Okay, but they're also used by speculators to bet on the direction and or the magnitude of price changes of these items. So you can either manage risk by locking in your terms, or you can speculate with these securities. Then we have options, another type of derivative, and the word derivative means that the value of the contract is derived from the value or price of another asset, i.e. the other asset being these things here. So the value of the contract is tied to the value of the bonds, stocks, currencies, interest rates, or commodities that the contract covers. All right, then options. These are also contracts, and they give the buyer the right, if they want to, but not the obligation, they don't have to buy or sell a certain amount of an asset at a specified price. So it gives the owner of the option an option. Okay? You can do something, but you don't have to, okay, prior to a specified date. So options cover assets, okay, a certain amount of assets to be transacted at a specified price within a specified date. Okay? So the big item that options introduce into a situation is time. Time. All right. Two types of options. The call option allows the owner of the option to buy assets. Put options allow the owner of the option to sell assets. Okay? And we'll get into more detail in the later chapter. The price of an option is just a fraction of the value of the underlying asset. So you can control a large amount of an asset for a period of time with a much smaller amount of money. Okay? All right. Another type of derivative is called a swap. Okay? Used a lot in banking. Okay? This is a customized contract through which two parties exchange the cash flows or liabilities from two different financial instruments. I'm going to give you an example and you'll understand it. Okay? For a set period of time. So you have two parties that each wants what the other has for some reason, okay? And so they agree to a contract that allows them to exchange cash flows, okay? That's what this is. So banks participate in interest rate swaps. They do this to manage the risk of changes in interest rates, and we'll get into interest rate risk and portfolio management in a couple of chapters. All right. For example, Bank A owns a fixed rate 6% 10-year loan of $10 million. Okay, they originated that loan. Okay, Bank B owns a $10 million loan as well, and it pays a floating rate of 1% plus prime. So Bank A has a fixed rate, and Bank B has a floating rate. Okay? Each bank wants to swap the cash flow to the other. So Bank A wants the fixed rate, the floating rate, and Bank B wants the fixed rate. Okay? So they come up with a contract that enables them to exchange their cash flow payments. Okay? And we'll see what these look like, how large these have grown over the past couple of decades, and you can see that the value of these off-balance sheet items greatly exceed the bank assets themselves. All right, so note that banks can use futures, options, and swaps in addition to actually buying and selling loans to manage interest rate risk and to change the profile of or to adjust their loan portfolio. So these are the tools that banks have available to modify the way their loan portfolio looks. If the bank decides or the regulators decide that the loan portfolio doesn't look the way it should, banks can use these tools to adjust their loan portfolio. All right, let's take a look. So first thing I want to tell you is that most of these off-balance sheet items are done by the large banks. So these are the large banks, and this is the total amount of items that are done, at the large banks, and this is the total for all banks. So you can see the vast majority of these items are done at the large banks. So this is unused loan commitments. This is derivatives, and it's the same thing. Almost all of it's done at the large banks, okay? And most of the derivatives are interest rate contracts, the swaps. And once again, you can see almost exclusively done by the large banks. It's a very complicated area, and the middle and small banks just don't have the expertise to do them. All right. So another thing I thought is very interesting is the total assets on banks' balance sheets, almost 12 trillion back when this was done in 2009. The total value of off-balance sheet financing, 242 trillion. Okay? So again, these derivatives are much greater than the assets themselves. And that can cause a lot of volatility and turmoil in the financial system. This can be a very dangerous situation when the contracts control many times over the actual assets, the value of the assets themselves. All right, let's take a look at a closer look at the income statement here as we wrap up. So the income statement displays the amount of revenue generated by the assets owned, loans and securities, okay, and by charging fees on deposits and on loans. Fees, not interest, okay, and by selling services such as trust services, insurance products, wealth management services, and payment servicing, okay, and it measures these items over a period of time, okay. So the income statement also has your operating costs, expenses associated with holding assets. What's for a bank? Your expenses associated with holding assets, interest costs on deposits and debt, okay? And then you have your overhead, like office, info systems, and people. All right, and then finally you have your net earnings. Part or all of net income will be reinvested in the firm to finance future growth. All right? So let's take a closer look. Some of it, the amount that's not saved to finance growth or to add to reserves will go out in the form of dividends. And that's the way all companies operate. All right. So let's try to take a different approach or different look at revenue. So revenue for a bank is equal to assets times the average yield on assets. All right. So the assets would be the average loan balance times the average interest rate earned on loans, and the average security balance times the average yield on securities. Okay? And then the average fee rate times the number of service transactions that are done. Okay? So this is a way, an interesting way of looking at how banks generate revenue. Okay? Then your expenses, your interest cost, which is your average deposit balance, times the average interest rates you pay on deposits, and then you have your employee costs and your office space, and you can break that down by the amount of space times cost per foot. Then you have your provision for loan losses, and we're going to take a closer look at an income statement in just a second, and taxes. Okay? So a different way of looking at the revenue and expenses at a bank. All right? Okay, so it is standard practice to classify revenue and expense into interest and non-interest categories. Let's separate out interest and non-interest categories. So, net interest income, and these are important terms that you'll hear Andrew talk about. Net interest income is interest income minus interest expense. That is net interest income. Okay? Interest income sources, interest and fees on loans, interest on taxable securities, interest on tax-exempt municipal bonds. Then you have your interest expense, which is your deposit interest cost, your interest on short-term debt, interest on long-term debt. And the difference between the rate earned on assets and the rate paid on liabilities is called the spread. Okay? All right, non-interest income sources, fees earned on trust. So let's take a quick look at trust. There's a whole chapter on trust. We're not going to get into it. Managing and protecting a customer's property. So you go to a trust department and ask them to provide these services. Okay. Corporations use trust departments for bonds, interest and dividends. Okay. Bank trust departments manage retirement plans. Okay. Then there are service charges on deposit accounts like insufficient funds, things like that. Then you have trading account gains and fees, considered part of non-interest income. Trading account gains and fees. Then you have wealth management fees and insurance fees. Okay. So trading account gains and fees are included in non-interest income. Okay? But then we'll find out that security gains on securities held to maturity are a separate line item at the bottom of the income statement. All right, non-interest expense, wages, salaries, and benefits, office space and equipment. And again, as I just mentioned, note that securities gains on bank security investments are not a part of revenue. Okay? Gains and losses in the trading account are part of non-interest income. These are listed on a separate line item below. Okay? Gains and losses in the securities held to maturity account are not a part of operating income. All right. That's important when it comes to some of the performance measures that we're going to look at in Chapter 6 and that Andrew also looks at. All right. So here's the income statement. All right. So we have total interest income up here. And we have total interest expense. This is an actual income statement. And we have net interest income, which is total interest income minus total interest expense. Then we have the provision for loans and lease losses, and this number is somewhere between 1 and 2% of the value of the loan portfolio. Actually, I think total assets, actually. Not loan portfolio, but total assets. Okay? Then we have, so we have total non-interest income. So if we have, we have net interest income, less provision for loan and lease losses, and that gives us really, shows us how much money we're making on our loans. All right, so our non-interest income is all these fees here, okay? And then we have salaries and benefits right here, 2.5, compared to interest expense of 2. So you get a sense of how big that is as well. Then we have our space costs here. And way down here, after pre-tax net operating income, we have securities gains and losses on the bank securities. So note that trading account gains and fees are up here in non-interest income, and securities gains and losses on longer term securities are not a part of operating income. Okay? So it's important to note these two items and how they're separated. All right, there's your net income. All right, so so we have interest income of 7. Let's say, so it's 7 million. And we have net interest income of 5 million. So we have $5 million there, and we have 2.8 million in provision for loan losses. So 5 minus 2.8 is 1.2 million, is what they're making through their lending and securities. Okay. Then they have non-interest income of 3.5 and non-interest expense of 4.7. So they're losing money on their non-interest expense, on their non-interest activities, but they would have a lot of these expenses anyway, so this is just a contribution. This is a positive contribution, but they're making 1.2 million on loans, and they're actually losing a little bit of money in the non-interest areas. And then they have to cover the 2.5 here. Oh, these numbers make up the 4.7. Okay. All right. So additional non-interest expense, I'm not sure what that is. Wish we had some of that information because it's larger than their net income. Okay. All right, but you can see the big items: interest income and the interest expense, the provision, other non-interest income, which are fees, and then salaries and occupancy. And this is probably data processing. Probably data processing. All right. So let's express these income statement items as a percentage of assets. Okay? So total interest income, which is a form of a yield, okay? So the banks earn about 4%. It ranged from 5% for small banks to 4% for larger banks. Their total interest expense ranged from less than 1% for large banks to 1.65% for small bank, for